Hi guys, welcome to Investing with JYK, and today we'll discuss preferred shares, especially in the context of this company called Seaspan Corp. Okay, so Seaspan Corp. So there's a website that is quite useful. It's called Quantum Online. So you have to register, I think, or something, and then you can look up different um, companies and their related debt or preferred shares. Okay, so we'll just look at this G series. So a company can have many series, many issues of preferred shares, and some of them will have different uh, liquidation preferences. So they're actually sitting at different levels of the capital structure. And if you think about capital structure, it's really like at the bottom is uh, so imagine at the bottom you got the common stocks, and then above that you have different series of preferred shares, and then above that maybe you have like mezzanine debt or some kind of junior debt, and then above that you have some kind of senior debt, and maybe above that is like secured senior debt. Secured just being means that it's backed by some kind of asset. So what happens is when things go well, everybody on top just get pushed up. They don't. The value of all these don't change, and the common stockholders' value would increase. So that's the part that will increase. And when things go bad, if the company goes bankrupt or goes into some kind of a liquidation, the way it works is the top ones get paid out first. So the secured debt holders will get paid out, and then maybe the senior secured, some kind of mezzanine. Uh, then you have a senior unsecured, and then you get some kind of mezzanine debt, and then maybe you have the preferred shareholders, and within them there will be different liquidity preferences. So basically, the way is if you have $10,000 left and you owe somebody in terms of like secure debt owner, it actually gets slightly more complex. There's recourse and non-recourse debt, but let's say we ignore that. Just say you first pay the secured owner, and that's like $5,000, and then you have the senior owner, which is $10,000. So now you're down at 4,000, and maybe a mezzanine of another $1,000. So you got 3,000, and then you got the preferred shareholders 2,000, and then at that bottom you got 1,000. So all there is for the common shareholders is that $1,000 if in a liquidation. But if the company loses another $10,000, then common shareholder will get wiped out. And if the company loses another $1,000, then all the preferred shareholders will be 50% down, and so on. Excuse me. So preferred shares are more similar to debt, if you think about this, than to common shares, and that the reason is they all have some kind of face value that is meaningful in the sense that most preferred shares can be redeemed at a fixed amount, and debts always carry some kind of face value. Obviously, you also can get to more weird things like convertible bonds or convertible preferred shares and all that, but we will not get into those for now. So let's look at the things, the important attributes of a preferred share. So the first thing that jumps out at you is it's 8.2%. What is that? That is actually the dividend rate, dividend yield for this. So if you buy at the face value of 25, you will get 8.25% per year. And so you can see that there is a thing called liquidation preference, $25 per share. That's what I said. That's essentially the face value. this is what you will get in an event of a company liquidation, so some kind of either someone buys it out and pay you out, or the company goes bankrupt. You will get $25 if there's any money left after the debt holders take their claim. So the debt holders will take their stuff, and you are below all the debt holders, right? So you're below all the creditors. You're the preferred owner, and then you get your $25, and you will not get more than the $25 in that case. And it also says redeemable at the issuer's option on or after some particular date at $25. So basically, that's almost like the maturity date for a bond. So at after this date, after 2021, the issuer, i.e. Seaspan, has the option, so they can, but they don't have to. They can redeem these shares for using $25, and plus obviously the unpaid dividend, because after, if you redeem just at the day of X dividend date, or 30 days, 50 days after that, obviously it's different. So it's basically just fairness here. And it was no stated maturity. So basically, the thing never matures. So there's never an obligation for the company to redeem these shares. And then it says cumulative distribution of whatever, 8.2% per annum. So $2.05 per annum, or 0.5125 per quarter. So that's the amount of payment. Cumulative just means that if they skip a payment, there's essentially like a accumulation of these payments. So since this is a dividend, this is not an interest payment, so there's no contractual obligation for them to pay you. They have the option of suspending preferred share dividend payments. Obviously, once that happens, it's usually when the company is almost dead. So the value of your preferred shares will take a huge hit. And cumulative just means that when they reinstate the dividend, they will pay whatever was left unpaid previously. Now, there's an important point here is usually for the common shareholder to get even 1 penny, for any of them to get even 1 penny of dividend, first of all, the debt interests have to pay, that's for sure, but also the preferred share dividends must be paid. And if it's cumulative, that means all the accumulated dividend that was unpaid has to be paid before the common stockholder takes a payment. Okay. And then there's some random crap about when these things are paid, but you don't really care too much, except maybe when you're calculating the stripped price. Stripped price is basically the price of the of this preferred share minus the interest that is already the dividend that's already built in to that to this share. So an example would be 1 day before the X dividend date, right? The price should be almost 0.5125 above it, whatever it otherwise would trade at. And then on that X dividend date, all that will be paid to you, and the price would reduce by 0.5125. That's all it matters. So basically, when you buy, you kind of have to think about that. All right. And this is also important. So you got the preferred shares are ones that have preferential income tax treatment, and some don't. So these ones have qualified. These ones have qualified dividend payments, and there are some that have non-qualified, and those would be taxed at your ordinary income rate. So yeah, so that you have to pay attention as well. And it says something about corporate holders. Since I'm not a corporate holder, I don't really care. It's not rated, but that's what we are for. We should be looking at the company's financial situation and understand what the company does to an extent. And so here it says, in regard to payment of dividends and upon liquidation, the preferred shares rank junior to senior debt equally to other preferreds of the company. So that's what I said. Like in this company, they don't actually have any mezzanine or anything like that. Just senior debt, and then immediately below that is the preferred shares. And then these preferred shares, they, as you saw in this screen, they have a bunch of preferred shares and some senior notes, right? So all these are ranked equally. So there is no preference. But in certain companies, especially in like startups, the preferred shareholders actually form a ranking on themselves. So like A might be more senior to B, might be more senior to C, or the other way around. Usually the other way around. Okay, so let's go back to here. And senior to common shares of the company, that's obviously the case. And so, okay, so let's look at what they're trading at. So this stuff is currently trading at $24. Remember, the liquidation preference and the redeemable price is 25, right? So there is somewhat of a discount, which means the effective yield is going to be higher than 8.2. So this stuff actually is going to get you per year was like 2.05, I remember, if I remember correctly. The payment is 2.405, yeah. So SPG, right, so 2.05 divided by 24.069, you're getting 8.5% dividend, which is reasonable. If this thing is stable and then you can count on it paying that for next 10 years, you're mostly at the point of no concern. Obviously, money is still money, so it's just some way of playing, like giving yourself a it's playing with your own psychology, right? Okay, so now we need to understand whether the company can keep paying the preferreds. So now we need to dig into their annual report, as usual. So this is F9. So what does a company do? So Seaspan, I'm just going to put the screen on a balance sheet. Yay. Okay. So what does Seaspan do? Seaspan is a container ship leasing company. What that means is they just buy a bunch of container ships and they lease out to these big shipping companies like MSC or something, and Costco or something. They have like 5-6 clients, and that's all they deal with. So they have really large clients. It's good and bad. Bad in the sense that if one of them go bankrupt, they'll get pretty screwed. So that actually happened in 2016, I think. The Korean one, Hanjin, went bankrupt. So that's a risk, okay? And obviously that means they are doing something that's super capital intensive, in the sense that they actually don't lease. They give them as a charter. So what they provide, both the ship and the crew, I think, ship, crew, fuel, all that is Seaspan's money. And the other company, the shipping company, basically find the demand, find people that wants to ship stuff, and manage all the rest, like coordinating people, like loading and unloading, all that things. Okay, so Seaspan is at the super capital intensive part, and you can think about, if you think about this, the most expensive part of shipping is the ship. And in order to finance the ship, they need to borrow a lot of money. And if you borrow money, you have to pay interest. So that's something we have to keep in mind. And then, so they are basically bearing all the fixed cost. And then the shipping companies, the actual shipping companies, a lot of them don't bear too much of that fixed cost. Okay, so let's look at their balance sheet. And their current asset isn't much, $380 million, compared to their total asset, close to $6 billion. So that is expected. So this thing is in thousands, I think. Yeah. So that's that's expected, right? So you want all your money being in ships and then have these chartered out. And so they got this guy, gross investment in lease. So that's the lease and chargeback stuff. So the accounting got changed. The accounting rules got changed, I think, for the better. So now you can actually see these. They used to be off balance sheet stuff. So this is a lease agreement. So they signed. They bought some. They did a sale and lease back. So they sold the ship to some other company and then lease it back. The reason is probably they need the money to do something. But obviously, you don't want to see too many of these. Goodwill, just crap. But very small portion. So you're looking at about $6 billion in asset. Very little of that is current. So you might be worried, oh, can they pay the money? But I won't be too worried because most of their charters are long-term charters. I think a bunch of them are like 10 years or something. And then let's look at the liability. So you got things that you have to pay. So the current liability is about 400K. So it's 400 million, right? And then half of that is long-term debt due. So that's something you have to watch out for. So they have a lot of debt, and then a bunch of them will come due in every year from now on. And their long-term debt, the current long-term debt is about $2 billion, and some other long-term liabilities, and then the capital lease thing, right? So that corresponds to this guy. Where is that? Where is that? Oh yeah, corresponds to this. This thing corresponds to this. Okay. So, but majority of that is just the long-term debts. And then if you do the subtraction, the shareholders' equity is about $1.9 billion. Okay. So within that $1.9 billion, let me think. We got the I'm actually not sure. I'm not sure how much of that is the preferred shares. I know preferred shares they issued quite a bit, but let's keep looking at the revenue. Sorry, at the income statement. So that's how much money they make on the paper, but you can see that they had some loss in 2016. This is because the shipping charter rate went down a lot, and that's because container shipping itself, the price went down a lot. We can see it here. You got this is the price for container shipping. This whatever company, they have some kind of index, and regardless of how good this index is, you can see that the highest it went was before 2006, so something like 2005-ish. And it went 1.8 thousand per, I think it's per day per TEU or something. But regardless, it's the range that matters. So the lowest it went is obviously at the financial crisis. It was like 275. Now it's a little bit more than double that. Okay, but it's still very much lower than the median or average here. So 2016, that's when things were really bad. So they lost a bunch of money. So that's looking at that, we know how bad the company can become. So if it goes to one of those really low rates, they will lose money. But they didn't lose hugely per se. They basically lost 1 year of earning, a little less than 1 year of reasonable year earning. Right, so 2015 had this bump, 2017 had this bump, 2016 was bad. If you look at 10 years, you can see that 2015 had a bump, 16 was really bad, 17 was okay, 18 is actually much higher now. Okay, so we should be expecting this profitability ticking up. And let's go down to, oh, and the other thing, notice even though the this is a weird thing. Notice how this number is higher in terms of magnitude, absolute value, than this, but this is smaller than this. This is very, very funky. And here, again, the magnitude is much higher, but the absolute value is much lower. That means the share count is constantly changing. And you can see that in the equity statement as well. So you can see it here. You got so these number of shares, 5 million shares. Right. So for preferred shares, total in 2014 they had 240. So let's see. 1,000. So 237,000. That doesn't sound right. Should be million, I think. Oh, this is sorry. They're lumping together. They're using the par value. So this doesn't mean anything. You basically have to count this. So if we count all that, they redeem this in 2000, and this is 15. So let's look at 17. So they got these guys outstanding, which means they got 5030. Let's just count in. Oops. Let's count in thousands. It's easier. Otherwise, too much to type. Plus 5416 plus 5600 plus 7800 plus 9025. Okay, so that's the number of preferred shares. All these are 25 par. So essentially they have $822 million. So hold on, we got a 3. Yeah, so that's $822 million in preferred share equity. So you have to subtract that from the balance sheet here. So if you do 1949 minus, so the common shareholders' equity is actually about $1.1 billion. Okay, so $1.1 billion in common, and then 822 in preferred equity. Okay, and if we look at cash flow, we always need to make sure that there's excess cash flow that can be used to pay the preferred dividends. So their cash flow actually looks pretty good, which is very common in these shipping industries, because once you bought the ship, all you need, they depreciate, and the depreciation doesn't show up on the cash flow. It will show up as investment in a way, because you have to buy a new ship to replace the depreciated part, but it's indirect, and then there's a time lag as well. Okay, so cash from operating activities is constantly around 300, 350, so $320 million. And then they use about 200, close to 300 to do the investment, right? So that will give you the free cash flow. But in 2015, they bought a bunch, which is actually a bad thing if you think about it. They bought it when the price was high. 2015 is when the price is fairly high. Well, actually it went high, then went low again, because this is 14, maybe 15, 14 to 18, right? So this is the 14, 15, 16, 17, 18, right? So 15, 16, 17, 18. Okay, so 15 is around here, this portion. So it had a high portion and a low portion. I don't know when they bought it, but in any case, it was higher than here. If they bought the ships, if they bought some used ships at this part, then it would be really nice. But you can't ask too much. And also, because we're talking about preferred shares, I don't really care about how much the common shareholder gets, so long as there's anything left for them, I'm okay. And yeah, so then you look at the financing activities. So what do? They issue some preferred shares, in fact, a lot in 2016. And then they issued a bunch of common shares. So they got a dilution. And the nice thing about preferred shares is that I don't care about dilution, because this is actually a lot if you think about it. The whole thing is $1.1 billion in common equity. This is 10%. Right? So this is close to 10% again. So you're looking at 20% dilution almost. But for common, you got dilution, but for preferred, there isn't really dilution, in the sense that my liquidation preference is, and the redeemable price never changes once they get issued. And they paid a bunch of money, they borrowed a bunch of money, and in the end, for financing, they were paying back this year, and like in aggregate. And if you look at this, is what you need to pay attention to. And these two lines, basically. So if they were to pay out anything, they have to pay this line, right? So that means if this number is fairly large, you are very safe. If this thing is getting close to zero, you're in danger. So they cut dividend on common in 2017, so that got much lower, so you actually get threatened a little bit. And also this is going up because it issued more preferred shares. So you always have to keep watching these. When this gets too close to, when these two added up, and then in interest, I don't think they have the interest in here. Nope. No interest in here, but if the financing cost, essentially the common dividend, preferred dividend, and interest added up, is getting very close to the interest payment, obviously, not just the interest accumulated, interest payment, get very close to this line, then you're in trouble. This will get cut first, and then this is the next on the chopping block. And investing activities, these can always be deferred in a sense. These ships, they run for 20 years. you don't have to replace them just yet. So if you are looking to invest in preferred shares, I worry a lot less about the ship depreciating than the common shareholder. Okay, so that's as far as we're gonna look at their situation. So if you're to for disclosure, I actually hold some SSWG, right? So if you want to hold a preferred share, to think about it more like a high-risk junk bond. And the nice things about them is you get preferred tax treatment, and secondly, sometimes they, the price changes a little bit. So sometimes they go to 20 or something, and then if you buy at 20, and they will go back to 25. And for a company like this, SSW is a cyclical company. It's much more difficult to buy the common shares. But remember what I said about cyclical companies. If you bought them when the commodity they were selling was cheap, right? So these places, 2016, you will make a lot of money. But at this point, do I really know if the company can, if the prices will keep increasing? I don't. But I'm fairly sure if it doesn't increase and if it just stick around here, they will be able to pay my preferred dividends. So it's one of those less risk and less return thing. And if you were to look at their graph, if you look at SSW, we can look at this. Does this thing have a 1 year? What the hell? NASDAQ is so useless. Anyway, so if you look at this, if you bought in 2016, actually, this thing didn't go up at all. I take that back. But if you bought in 2009, but that just means, that simply just means that you're buying at the economic low end. But I think the reason they didn't go up that much is they did not suffer that much. Their charters are long-term charters, so that might be the reason it didn't actually go up a ton. But yeah, keep an eye on this. If you got in when they're fairly cheap, you get lower risk. People will always need shipping. It will never go away. The only problem is if they can keep paying your dividend. I think that there's a high probability they will keep paying my dividends, even into 10 years. So I parked some cash here just to get that 8%. I think when I got it, it was like 8.5-ish, or a little bit more than that. I got in about $22 or $23. So 2.05 divided by 23 is like 8.9. Yeah, so I got close to 9% dividend. So that wasn't too bad. Okay, so if this is useful, and if you like the content, please subscribe and click like. And I'll probably introduce a few more preferred shares. Preferred shares is one of those things that are often overlooked. I think one should be well versed in all the levels of the capital structure. So be it common, preferred, or debt. So all these things. And because opportunity can present themselves at any level of the capital structure. All right, that'll be it for today. See you next time.